You have $10,000 sitting in your brokerage account. Today is the day SpaceX goes public. The ticker is SPCX. The price is $135 a share. And every finance podcast you follow is talking about rockets, Starlink, Mars, the most admired engineering company on the planet. Then you open a plain vanilla index fund. It returned 10% last year. It returned 10% the year before. It is boring. Nobody makes a podcast about it. So the question sitting in front of you right now is not which company is more impressive. You already know the answer to that. The question is, which one makes you more money over the next 10 years? And those are two completely different questions. If you are a self-directed investor in your 30s or 40s who trusts numbers over narratives, that gap between the two questions is exactly where most people lose money. It is not a discipline problem. It is a price problem. Here is the number the hype will not show you. SpaceX is entering public markets at $1.75 trillion in valuation. It generated $18.7 billion in revenue in 2025. Divide the two and you get a price-to-sales multiple of roughly 94 times. 94. For context, Nvidia, the most dominant AI chip company on the planet with a 62% net profit margin, currently trades at around 20 times sales. SpaceX trades at more than 4 times that multiple and is losing money. That is the gap this video is about. Not whether SpaceX is a great company. It is. The question is, what price makes a great company a great investment? I call this the story premium. It is the extra dollars the market charges you to own a narrative before the numbers catch up. Every transformational company in history has had a story premium. The question is never whether the story is real. The question is how much of the story is already in the price. If you want more breakdowns like this, ones that put the actual math in front of the story, subscribe to Salary to Strategy. We do one of these every week. Now, let us look under the hood. SpaceX reported $18.674 billion in revenue for 2025. That is a 33% increase over the prior year. That sounds strong, but dig one layer deeper and the picture gets complicated fast. The company has 3 business segments and only one of them makes money. Starlink, the connectivity segment, generated $11.387 billion in revenue in 2025. Operating income was $4.423 billion. That is a 39% operating margin, which is genuinely excellent. Starlink is a real business with real profits. It is what is keeping the lights on. The space segment, the rockets and launches, generated $4.1 billion in revenue, spent nearly $3 billion of that on Starship development alone. Thin margins, enormous capital requirements. Then there's the AI segment, formerly XAI, which SpaceX acquired in February 2026 in a deal valued at $1.25 trillion, the largest corporate merger by valuation in recorded history. In 2025, that segment generated $3.2 billion in revenue and posted an operating loss of $6.355 billion. Starlink's profits are not funding growth, they are funding XAI's losses. The bar chart here is striking. Imagine 3 bars. The first bar is Starlink, tall and green, operating income $4.4 billion. The second bar is the space segment, roughly flat. The third bar is the AI segment, a red bar that drops $6.355 billion below the line. That red bar is bigger than the green bar. On a net basis, SpaceX lost $4.937 billion in 2025. Now here is something the S1 filing shows that almost nobody is talking about. Starlink's per-user revenue is falling. In 2023, average revenue per subscriber was roughly $99 a month. In 2024, it dropped to $91. In 2025, $81. In the first quarter of 2026, $66 a month. That is a 33% decline in average revenue per user in 3 years, even as subscriber counts doubled. Subscribers are up. Revenue per subscriber is down. Extra customers are not generating much incremental revenue. That is not my phrase, that is from Tim Farrar, president of satellite research firm TMF Associates, speaking to CNBC this week. The growth story is still intact, but the unit economics are softening in real time. And in the first quarter of 2026, the operating loss for the entire company was already $1.943 billion, which is roughly 75% of the full year 2025 loss in a single quarter. The AI spending is accelerating, not stabilizing. So that is the real business underneath evaluation. Now let us do the math that matters. Here is the framework I want to introduce. I call it the what has to be true test. It is the most honest question in investing. Not is this a good company? Not do I believe in the mission? But given the price I am paying today, what does the future have to look like for this to be a good investment? Most investors skip this question. They fall in love with the story and forget that the story already has a price tag. The what has to be true test forces you to work backwards from the price and decide whether the required future is plausible. Let us run it on SpaceX right now. This is our illustrative model built from public S1 data. The assumptions matter, and we will name them explicitly. Starting point $1.75 trillion valuation. To match a boring index fund returning 10% per year, nominally over 10 years, your investment needs to grow to the same place the index takes you. 1.10 raised to the power of 10 equals 2.59. So 1.75 trillion needs to become approximately 4.54 trillion in 10 years just to tie the index. Not beat it, tie it. Now, a company does not trade in a vacuum. It trades at a multiple of its revenue. Let us assume SpaceX matures into a still richly valued but grown-up company trading at 8 times sales in year 10. That is a generous assumption. Profitable software companies with strong moats often trade at 8 to 12 times sales. Slow growth industrials trade at 1 to 2 times. 8 times is assuming SpaceX is still a premium business a decade from now. At 8 times sales, a $4.54 trillion market cap requires revenue of roughly $567 billion. Today, SpaceX has $18.674 billion in revenue. To get from $18.674 billion to $567 billion in 10 years requires a compound annual growth rate of approximately 40.7% every single year for a decade. The bar just moved. Let us look at it from a different angle. If you change the exit multiple assumption, the required growth rate shifts. At 6 times sales, the required annual growth rate rises to about 45%. At 10 times sales, it drops to about 38%. The range is 38 to 45% compounded annually for 10 years. There is no scenario where the math gets comfortable. That is the story premium you are paying at 94 times sales. Now you might be thinking, Thane, companies have done this. Amazon lost money for years at crazy valuations and made early investors rich. You are right, that is the strongest case for SpaceX, and I want to give it its full weight. Amazon's path to astronomical returns required inventing AWS, a cloud computing business that did not exist when the stock was cheap. It was not an extension of the retail business. It was an entirely new market that nobody priced in. If you bought Amazon at what looked like a ridiculous multiple in 2001 and held for 20 years, you won because the company created a second engine that nobody modeled. SpaceX has a candidate for that second engine. It is called Starship. If reusable heavy lift rockets become the backbone of a new space economy, point-to-point Earth travel, orbital manufacturing, lunar logistics, the revenue opportunity could be unlike anything we can model today. SpaceX also has the Anthropic compute lease, generating $1.25 billion per month from its Colossus data center through May 2029. That is real contracted revenue beginning to flow. And Starlink itself grew 86% in adjusted EBITDA from 2024 to 2025. Subscribers doubled. The network is real, the mode is real, and there is no close second in the satellite internet market right now. That is the legitimate bull case. It is not hype, it is a genuine possibility. But here is where the what has to be true test does its real work. Amazon's AWS moment required inventing something new. For SpaceX to justify 94 times sales, Starship must not only work commercially, it must generate revenue at a scale that makes today's $18.7 billion look like a rounding error. xAI must win in a market currently dominated by OpenAI and Anthropic, companies with enormous leads and billions in capital. and Starlink must reverse its declining average revenue per user while maintaining its margins as it competes in developed markets against established fiber providers with pricing power. All three of those things must go right simultaneously. For a decade, at 38 to 45% annual growth, that is not impossible, but it is a very specific future. And the question you have to answer honestly is whether that specific future is priced in or merely possible. There is a second layer problem that almost nobody mentions. Morningstar equity analyst Nicholas Owens published a discounted cash flow valuation of SpaceX at $780 billion, roughly 55% below the IPO price. He described the $1.75 trillion valuation as requiring flawless execution from a company currently posting net losses. His model assigns the core launch and Starlink businesses a combined enterprise value of $611 billion and adds $170 billion in probability-weighted value for the AI segment. That blended total is $780 billion, not $1.75 trillion. Aswath Damodaran, the NYU professor known as the Dean of Valuation for his transparent public models, puts SpaceX equity value between $1.25 and $1.35 trillion. Still below the IPO price, but meaningfully above Morningstar. Damodaran called it too richly priced and noted the investment is at this level a loaded bet on AI and on Elon Musk. So you have two of the most rigorous independent valuation frameworks in public finance, one at $780 billion, one at $1.3 trillion. The IPO is pricing at $1.75 trillion. The gap between the low end of those estimates and the asking price is somewhere between $450 billion and almost $1 trillion. That gap is the story premium in dollar terms. Now here is the part where the natural objection arises. You might say the market prices future expectations, not current financials. Fundamentals do not matter for momentum, and in the short run, you might be right. With only 3% of shares being floated, with Goldman Sachs and Morgan Stanley and JP Morgan behind the underwriting, the stock could open well above $135 on sheer demand pressure. Owens himself acknowledged this, recommending that long-term investors wait for post-lockup price discovery, which begins in earnest when the first insider sell window opens around Q2 earnings in August 2026. The short-term price action and the 10-year investment math are two different conversations. This video is about the 10-year math. So what is the protocol here? What do you actually do with this information? Step 1 is run the what has to be true test on any investment before you put money in. Not is this a good company? What does the future have to look like, numerically, for the price I am paying today to be justified? If you cannot answer that question in concrete terms, the price is not justified in your model. You are buying story, not math. Sometimes story wins. But story without math is not investing, it is speculating. Those are different activities with different risk profiles. Step 2 is separate aberration from allocation. You could think SpaceX is the most important company of the century and still choose not to own it at 94 times sales. Those are not contradictory positions. One is an opinion about technology. The other is a judgment about price. The index fund does not care about your admiration. It compounds at whatever the market delivers. Step 3 is watch the real metric. If you are interested in SpaceX as a long-term holding, the number to track is not subscriber growth. It is average revenue per subscriber. That number has been falling for 3 years straight, from $99 to $66 per month. If Starlink raises prices effectively in 2026 and ARPU stabilizes or recovers, the unit economic story improves. If ARPU keeps compressing as growth comes from lower-income international markets, the gap between subscriber growth and revenue growth widens, and the valuation math gets harder, not easier. Here is the reframe that matters. A great company at the wrong price is not a great investment. That sentence sounds obvious. It is somehow the thing we forget every time a genuinely remarkable company opens for trading. The rockets are real. The technology is real. The mission is real. None of that changes the arithmetic. At $1.75 trillion, SpaceX needs to grow revenue from $18.7 billion to somewhere between $400 and $567 billion over the next 10 years, just to tie what a boring index fund delivers. That is not a story about whether SpaceX can do great things. It is a story about whether the price you pay for great things determines whether you get rich from them. The index fund does not care about Mars. It does not care about reusable rockets. It charges you roughly 0.1% per year and compounds at whatever the market delivers. Over 30 years, that has been roughly 10% nominal. It has no story. It has no charisma. It does not go public on a Thursday with a record $75 billion raise. It just compounds. If you are a self-directed investor who likes running the numbers before the narrative, drop your honest answer in the comments. Would you buy SPCX at this price? What multiple would make you comfortable? I read every comment because the math people write in is always more interesting than the headlines. If this kind of analysis is useful to you, hit subscribe. We put out one of these every day. I am Thane, this is Salary to Strategy, and I will see you in the next one.